Thank you for deciding to watch this video. I intend to add my thoughts to the probably tens of thousands of commentators who have been interviewed on the mainstream broadcast media channels or have put out information through social media, Instagram, X, YouTube and so on. I'm not going to take up too much of your time, but I want to cover the topics in summary in an attempt to provide some clarity, because the mainstream media, as I will explain a little later, can present the material in such a way that one becomes confused, and this can result in the development of psychological biases, which is not helpful when making investment decisions. Mistakes could follow. I actually want to deal with this in 5 sections. Firstly, I'm going to look at the context, most of which you'll know, but I want to start somewhere to lead into my further thoughts. Then I'm going to look at the general media coverage and what I make of that. Then extract some information from what I've seen by way of professional media coverage, which is not necessarily that much better, and extend that into thinking about what the short-term textbook or academic implications would be for the various major asset classes which you might hold in your portfolios. Finally, I'm going to ask the question, should we be doing anything? And of course I will look at the hoary old chestnut of the difficulties about timing markets and making buy-sell decisions during periods of high volatility. I think there's plenty of evidence we can look at that supports the usual line of argument that you probably are familiar with. So, what's the background? Well, the background is obviously the actions and their implications for financial markets and economies of the incumbent of the White House, and you might generally say it's all about this new idea of tariffing everything. The concept that America, the United States in particular, rather than continental America, of course, can create a balance of trade, or make the balance of trade in its favour. And this is, we're talking about goods only, remember, something that's often missed. We're not talking about the overall balance of trade, but the balance of trade in goods can be pushed in favour of the United States such that Americans can buy stuff manufactured in the United States. I have to laugh because I think about the sort of stuff that apparently Americans do buy from the likes of Alibaba and Temu. You know, are we going to see huge factories set up in the United States to make rubber pet toys or $50 bundles of stuffing dressed up as a banana? I don't think so, but Donald Trump obviously does. There are some serious aspects to the events that are going on that will have to be taken into account by those making decisions. The first one is that conventional wisdom suggests increasing friction. Tariffs are a form of tax. They certainly create practical difficulties and generally put a brake on global trade. That sort of activity is likely to cause two things: inflation and a recession. Now, inflation and a recession put together are stagflation, which is the number one bogeyman for economists and probably for all our standards of living. Second point to note is that the person who is causing all this trouble has demonstrated he can change his mind, and I wrote at great length about the psychological aspects one might take into account in my February deep dive. So if you can't remember what I said there, I suggest you reread it. Broadly speaking, it is very hard to predict the sorts of decisions made by an individual suffering from a deep psychological personality disorder, and I and many others believe that is certainly the case with the current US president. It is unwise to consider that they have a well thought out plan. They don't. They react to the implications for themselves of developing situations, and they create plans that are likely to better either themselves or issues they fundamentally believe in, but which are generally fairly simple and which they won't give up on. And the fact that they won't give up on that issue means that reasoned arguments to the contrary very rarely are effective, only an extreme threat is likely to cause a change of mind. So I don't see Trump changing his mind. The Chinese saying they'll impose another 50% tariff is more likely to provoke him than result in any withdrawal of his proposals. Many governments are trying to negotiate with his officials. That might work, but his officials are not really going to have the power to make decisions whilst he is in the state of mind he has at present. Furthermore, businesses who decide that, well, that's the way it's going to be, we need to do something, are going to think, well, how long is it going to take us to make changes that fit with Trump's ambitions? How long does it take and how much does it cost to build a new factory manufacturing motor cars or washing machines or even shoes in the United States? Well, I've read figures of probably the best part of 2 years to get the factory up and running, and the best part of a couple of billion US dollars to make it work. Then there's the fact that the cost of manufacturing those goods, bearing in mind US workers, and a huge multiple in wages of workers in Vietnam or South Korea or Bangladesh or Turkey, the cost of the goods will increase considerably, and even the proposed high level of tariffs are not likely to make the US goods more competitive than those imported from, say, Turkey, with tariffs added. This is the context. General media coverage is along the lines of the absurdity of what is happening, and many interviews I have seen are with experienced people, economists, investment managers, other journalists. You will have noticed that when they're having difficulty getting specialists to fill in a major news slot, the production teams of the major news organisations usually get another journalist, sometimes one who even works for them, to be interviewed, which is hardly really very revealing in terms of factual content. Those discussions are all along the lines of, oh, this has never happened before, it could be the 1930s all over again, it's a disaster, people's pensions are being written off, and so on. All these sorts of discussions assume that what's going on at the moment is long term. In other words, this is what we're going to have to put up with for the foreseeable future. The world has changed, it's now different, and we're going to have the end of global trade. That's totally misleading, of course, because Trump won't be in office forever. He might want to be made king and have a third term, but he's pretty old. And in any case, the capitalist system is full of very powerful people. And if in the end they can't make money, they will react, and Trump will be in some way removed, or his decisions will be ameliorated. Furthermore, there are implications that are not developed in most general media discussions. For example, imagine you are a maker of shoes that's been supplying Nike, based in Vietnam, and Nike sales fall and Nike begin to withdraw their orders, or even do start to build a factory in Wisconsin or Alabama or wherever is appropriate in the United States. You have all the skills for making Nike shoes. Nike shoes in the US are going to cost more money, either because a tariff is added on the ones you were making in your factory in Vietnam, or because they're being made by American workers. And also, Nike's just spent $2 billion US dollars on building a factory, and it needs to get that back. So you can apply your skills to making Nike light shoes, let's call them Noki shoes, and you can market these in North America. Now, to start with, of course, you won't sell that many because people will say they're a knockoff. Then, of course, it will be realised that these are the same quality shoes, but they're cheaper, even with the tariff added. They're still cheaper because of the reasons I just explained. Furthermore, you can start to sell your shoes in markets that aren't applying a tariff, where you're significantly cheaper. And of course, the other markets of the world, this is not often mentioned, being China, Europe as a whole, not just the European Union, because Europe as a whole is a lot bigger than the European Union in terms of economies, and other parts of the Far East, Australia and New Zealand, the African continent. These are huge markets. Put them all together, they're probably 3 to 4 times the size of the North American market. You can start selling your Nike shoes there at half the price of Nike shoes, and after a while you'll take market share from Nike and you'll have a successful business. There's a brilliant example of this if you look at the business called Xiaomi, which learned how to make phones after effectively pinching people who worked for Apple, or even indeed manufacturing for Apple. I can't remember the exact history. Xiaomi is now the second biggest maker of mobile phones in the world after Samsung, having overtaken Apple. When did they start? 2010. So it doesn't take that long. Furthermore, they sell all sorts of other things, and I bought some of them, and the quality is excellent. Let's now look at the professional media coverage, which perhaps you would hope takes into account some of the points I have made. Well, in fact, it generally doesn't. A classic commentary from a long in the tooth, sort of my age, investment manager or boss of a major bank is, oh well, it's just another one of these crises, we come through them, look at what happened before, the market turned around and raced ahead again, so you needn't worry, it's all noise. That's the sort of cynical old man approach, and there's plenty of that to be read, and indeed it's probably valid. The alternative is those who say, well, there's an opportunity to make money here, you should invest in X, Y, or Z market for this, that, or the other reason. That fails to take into account, in my opinion, the general maxim that during periods of confusion and uncertainty, volatility will be up, and making a good decision, timing a purchase correctly, is exceptionally difficult. I'll return to that subject later on. So the professional media coverage, the stuff I'm seeing, is generally not that good either. However, some economic analysis looking at the implications for individual asset classes in the short term is good. So let's look at that now. Let's start with usual equities. Well, we're talking about the possibilities of a recession here. I think we have to assume that the implications of what's going on with tariffs are recessions in the developed market economies, and indeed some changes in emerging markets, possibly as some of them are able to take advantage of a shift in where manufacturing occurs. After all, as I said before, putting a big tariff on a very low price may still result in a good being supplied being considerably cheaper than a non-tariff good manufactured in a developed economy with expensive property, labour, banking and other infrastructure costs. So if we're talking about a recession in the developed economies, the classic view, and I think the one that's right in this situation, and the way the market is reacting, is that companies are going to make less profits, sell less, there'll be unemployment, people will buy less, it's a downward spiral. It could even be the equivalent of the Great Depression, and that's very bad for equities. Remember, equities as a whole lost a huge proportion of their value. Many companies went completely bust and became insolvent in the Great Depression. On the other side of the coin, we have, in that situation, fixed income, and there is evidence that money is coming out of equities and other assets and going into fixed income. The yields on short-term US Treasuries have fallen. In other words, people are prepared to pay more for Treasuries, therefore they get less interest. So the classic hedge effect of short-term fixed income stocks is evident, and I think is likely to continue to be evident. So if you're holding corporate bonds in your portfolio, that is a little bit of a shock absorber at the moment. However, longer dated bonds are not showing the same changes in interest rates, and you're getting a situation that I have explained in past written posts, which is the potential for a reverse yield curve where interest rates are the wrong way round. That also tends to be a prediction of a recession. Interest rates on longer dated bonds are lower than high dated bonds, even though in theory you're taking more risk. Commodities, well, the oil price has fallen dramatically, which is very bad news, particularly for Russia, and one wonders what Mr. Putin is saying if he's been on the blower to Trump about that. The Russian economy is hugely dependent on exporting oil, and the price has been below $60, which is actually the EU price gap. Russian media coverage, which I see thanks to that wonderful man Steve Rosenberg, who summarises it every day, is concerned. Let's put it that way. But a falling oil price may be a little help with inflation, so not bad. The gold price has shot up in the way that it's the safe haven, but came off during the most dramatic sell-offs, and I think that's because firstly it had become relatively expensive. Secondly, there are technical difficulties in the market, which I've explained briefly in a written post. And thirdly, I suspect just because people are at times so frightened they're selling everything. Retail investors will be scared enough to want to go to cash and put the money in Nationwide or premium bonds or whatever. The last asset class we would want to talk about is commercial property. Well, commercial property doesn't do well in a recession, and in fact there's very little argument for purchasing commercial property because of long-term structural difficulties in that market in any case. Putting the money in cash, if you want to call cash an asset class in this context, means you will get interest, but of course interest rates are likely to fall if central banks react to the threat of a recession by lowering rates. Interestingly, they're not doing that yet, but they will have to if a recession really comes through. I refer you back to point number one. We're having to look at short-term pronouncements, decisions that might be changed, might not be. There's too much uncertainty for central banks to take decisions based on what they have to guess are the long-term trajectory for inflation. Is the long-term trajectory for inflation. So that brings me neatly to the, do you need to do anything? Well, some people say, well, I want to get out because I've got profits, I could bank them, I'm scared of losing more money, I'd rather have the money in cash. Clearly, many people are doing that. That's why the markets are falling so sharply. If you're a retail investor, though, and you're expecting to have a portfolio for the long term, you need to be invested in the markets rather than on deposit because, for example, your retirement income depends upon your earning returns in excess of cash deposit rates to have an adequate pension, or if you're saving for your future in some way, you're building up a nest egg, you're going to have to own equities at some stage. If you're watching this video, you must believe that already. So if you sold out the market, you're going to have to get back in. The difficulty there is the market will snap back in 5 minutes, and I do mean 5 minutes. That happened yesterday. A piece of news, incorrectly reported, I believe, in social media, suggested that something was happening that was favourable and would result in a resolution of the tariff problem. The market shot up to the value I read somewhere of several trillion US dollars in 5 minutes. You, as a retail investor buying funds that are traded the next day, are never going to be able to pick up that sort of return. So you might exit the market. Let's say your portfolio has a nominal price of £100. Previously it was £120. You exit at £100. The market continues to fall, and you think, well, that was good because the market's now £75. The market snaps back very quickly, and within 2 days it gets to £105. You think, oh my goodness, I better re-enter. You make a purchase decision, another day goes past, the market's £108. You're buying the market back at £108, having sold at £100. You've lost 8% of your portfolio, actually lost 8% of your portfolio. Had you done nothing, you would not have actually lost anything other than on paper. Your portfolio would be worth £108 compared to its original £120, and no doubt the market will move past £120 at some future date. So trying to time the market as a retail investor is trying to catch a falling knife. As they say, you're likely to get your hands cut, and at the moment the knife is not just falling, it's zigzagging on the way down due to the irrational decision-making process going on. So in essence, I think you need to pay attention to the news and treat it as an interesting learning experience, but don't rush to make portfolio transactions. Don't rush to change asset classes. Don't rush to sell things. You've got a lot of cash. You could buy, but I think probably at the moment you're still buying on the downslope. I don't know that, of course. You're certainly going to buy stuff cheaper than you would have done 3 or 4 weeks ago. Is there going to be a time when we know the markets have got cheap? Yes, there is. There will be signs which we can't see yet. Interest rates will have started to fall, central banks will have started to react, and the news flow will sound completely different. I will try to detect that. I've got to be reasonably skilled at it over the years, and therefore I recommend you continue to read my Yap Your Attention Please posts on a regular basis. That's it for now. Thanks for listening.